afternoon, everyone. On behalf of SIAM Cement Public Company Limited, I would like to warmly welcome and thank you for attending our first quarter 2024 State Opportunities Day, and we appreciate your time and interest in our company performance. I have the pleasure of introducing our distinguished senior executive from SCCC who join us today. First, Khun Ranjan Sadewa, Group CEO and Acting Group CFO.
สวัสดีครับ
Khun Montri Nithikul, CEO Thailand Cement Business.
สวัสดีครับ
And today, the following agenda we will cover for first key highlights and following with financial performance, ESG, 2024 outlook and way forward, and after that we will have Q&A session. So let us begin the presentation by inviting Khun Ranjan for give us the key highlight of our first quarter.
Thank you, Kat. Good afternoon again and welcome to ICT Opportunity Day for SCCC Q1 2024. Before I dwell upon the highlights for Q1 for us, let's recap the global scenario in Q1, which saw global GDP growth rising, showing once again the resilience of the demand and overall growth happening in the world as a whole. This growth came essentially from US and China, the two largest economies, which is a good news. But it also has some positives and downsides. Positives, this means that the demand from Asian economies for exports will go up. And here, one of our countries, Vietnam, also partly Cambodia, Bangladesh will have an advantage as they see their exports to the West increasing. In terms of the downsides, the US strong economy means higher interest rates and inflation to continue for some longer period, which has impact on Asian currencies. As we have seen recently, Thai baht, Vietnam is dong, also Bangladesh taka depreciating against the US dollar, leading to higher inflation and continuation of higher interest rates in our region. Just after Q1, we also saw heightened tensions and a war-like situation in the Middle East, which over time it has a little bit subsided, but the probabilities remain there in terms of the war. And if that was to happen, it would be a different world altogether one more time when energy prices might go up as they went after the Russian and Ukraine war 2 years ago. So that remains a risk and geopolitical crisis lingering for some more time. Despite these uncertainties and issues globally, we have had a very good, successful Q1. And let's talk about in each of the countries. In Thailand, we have had challenges on the commercial side, on the market demand side, as we are all aware, primarily coming from the delayed government budget approval, the continuation of high household debt, and lower demand means intense competition in the marketplace. Despite these challenges, we have had a positive development of our operating EBITDA coming from lower variable costs, also lower fixed costs. Lower energy prices, FT, did not go up as originally announced or foreseen, but still slightly higher than Q4. But energy prices, coal prices remain lower and range bound. And this together with our continued Fit Plus program, giving us operational efficiencies, lower fixed costs, lower SG&A, meant we had higher profitability continued from Q4. Vietnam, Q1 is usually a subdued quarter as we have Tet holidays in Vietnam, which continued for 2 weeks. And there was a bit delay in the demand coming back. Also, we have annual shutdown of the only kiln in Hong Kong in Vietnam, happens always in Q1. Now, despite the higher costs of the shutdown and lower demand due to holidays, we see positive development of the demand coming back in the market. So overall, year on year, we recorded a better margin and a higher EBITDA in Vietnam. Overall, economic growth prospects remain solid, and we maintain our long-term positive view on expansion and growth in Vietnam. Sri Lanka, after a pause for many quarters, we saw the gradual recovery now coming, with Sri Lankan government having implemented a number of initiatives and reforms as agreed as a part of IMF bailout program. And we saw demand coming in both rural, urban, and semi-urban areas, leading to higher volumes. Prices were also somehow maintained, and with lower costs, both variable and fixed costs, we had a better margin and profitability in Sri Lanka. So overall, these are all 3 countries, our main countries, contributing positively to the top line as well as much better, healthier bottom line. Sustainability, our initiatives and actions continue. As we mentioned in the last update, we are focusing on TSR, which is thermal substitution rate, replacing coal with waste and other materials. And this ratio has been improving quarter on quarter, year on year for us. And in Q1, it reached a very respectable or healthier percentage of 27%, up from 21% last year and 16% in 2022. We further reduced our clinker factor to 71.6%, highest we have ever achieved in the last, I would say, a decade, from 72.6 in 2023. Both these initiatives lead to massive reduction of CO2 emissions from our operations. As also mentioned last time, in terms of solar power project, we have now completed the establishment of a joint venture company with our partners Big Green to start a new renewable solar energy project in our own lands in Saraburi plant for 100% for captive use. It's about over 80 megawatt E, and this will be commissioned in end of Q3 next year. And this will mean that in addition to the existing renewable energy that we will have in total 36% by end of next year, which is in line with our goal of 50% electrical energy through renewable resources by 2030. Okay. Broad highlights. This is a summary slide. We'll go into the details in the subsequent slides. First, on the revenue, we recorded a revenue of 10 billion baht in Q1, up 4% quarter on quarter, so which means steady growth. However, lower than the same period last year, where we had still good contributions from Vietnam. Also, we had higher clinker exports from Thailand. In terms of EBITDA, 2.3 billion baht in Q1, which is higher 38% year-on-year, as I mentioned earlier, primarily from the higher performance in Vietnam and Sri Lanka, and also overall across all countries, lower variable and fixed costs, variable costs coming from lower energy costs and fixed costs coming from the restructuring, the tailwinds we have from the restructuring carried out last year, and still 1% plus quarter-on-quarter. Net profit at 1.147 billion baht, 39% higher quarter-on-quarter and 51% year-on-year. Now, net income or net profit follows EBITDA, but we also had one-off gains in the exchange rates quarter-on-quarter coming primarily from Sri Lanka, where the Sri Lankan rupee has actually appreciated to 300 Sri Lankan rupee to USD levels compared to 340, 350, even 360 last year. Free operating cash flow, we struggled with free operating cash flow the first 6 months of last year, subsequent to which we carried out multiple initiatives on the net working capital side, and those have been fairly successful. We saw healthy free operating cash flows in Q4 last year, leading to a very healthy opening cash balance, and those initiatives continue through in Q1 this year. So overall, 2.3 billion baht of free operating cash flows, which is multiple times higher than statistical Q1, which was a low quarter for free operating cash flow. Just summarizing again, the key achievements on our continued initiatives on sustainability, primarily CO2 emissions reduction. So clinker factor improving by 100 basis points quarter-on-quarter. Likewise, thermal substitution rate improving 610 basis points to 27.3%, and starting off the joint venture with Big Rim to set up a solar farm in our Saraburi lands.
Financial performance by group. So we start with net profit in English for the group, and also EBITDA and net profit.
So we just talked about revenue, EBITDA, and net profit. I will highlight a few other important points not mentioned in the previous slide. Very proud to share the continuation of higher EBITDA margins. If you recall, 23, we struggled between around 15% EBITDA margins throughout the year. In Q4, we start to see energy prices lowering, the impact of the cost optimization efforts showing some results, and we ended Q4 at 24.5%. In Q1, in Q1, we have recorded 23.6%. Our Q1 is traditionally a low margin quarter, as we have kiln shutdowns in most of our plants, primarily Q1 and some in Q2. So that contributes to lower EBITDA margins. But if you look at overall like for like, I think it was as healthy a quarter as 2023 Q4. Same for the net income margin, improving from going up from 6-7% in H1 to 8-9% in H2, Q4 at 8.6%, and now in Q1 at 11.4%. Strong cash flow generation continues in Q1, as I mentioned also a little while ago. 2.5 billion baht coming the cash flow generated from the operations, and a healthy cash ending balance at 7.7 billion end of March 2024. So higher profitability, higher cash generation means our net financial debt now much lower compared to Q1 23, and which results in the reduction of gearing by almost 17%, and now from 59% to 42% at the end of March 24. This is very much in line with our objectives for 2024 to reduce the debt, gross debt, and maintain and bring our overall gearing to, let's say, late 30s or maintain around 40%. In terms of liquidity, no concerns. As I mentioned, we are sitting on a healthy cash balance, which we will use to pay off the 2 debentures which are maturing this year. In fact, post the event, we have already repaid the 2 debentures which matured early in April and May. And also, we use the cash effectively to pay the dividends for last year in the month of April. In terms of overall liquidity, we still have unutilized committed credit lines of 9 billion baht, which we obtained in 2020, 2021 during the COVID time, and they still remain unutilized in addition to plenty uncommitted credit lines that we have.
Next, we will go to by geography, starting with Thailand first. Montri can share for us.
Thank you, Ms. Ringgit. So the overall market demand in Thailand in Q1 was very soft. This is mainly due to the delay on the budget from the government. So that the big impact to the demand in Q1. And however, we foresee that after the budget has been released by the government in last month, April. So we foresee that in the second half of the year, we quite positive in terms of the market demand. So, and however, we also be facing a lot of issue as well, about the high household debt, for the Thai market. And as a result, we expect that the demand in this year, so we foresee -3% as the total year. And actually, this is because of the first 4 months, we lost already the market demand is about 11%. And we think that we can catch up in the rest of the year. So that will help to maintain the demand in the market is around -3% at the end. But for SCC revenue, when looking at the revenue in Q1, in fact, it's improved from last quarter, it's about 5%. This is because of the seasonality that Q1 normally we have the high sale volume. But however, when you're looking at the performance compared to Q1 last year, this is quite significant drop, mainly because of the delay on the budget from the government, and also we lowered our export clinker, so that's the reason why the revenue dropped around 15%. However, when looking at the bottom line, the EBITDA, so you will see the good performance, 1.9 billion in Q1. This is a little bit lower than Q4 last year, only 5%. Even though that we're facing about the cost because of we have the shutdown cost in Q1, but we still deliver 1.9 billion. It was good performance, and this is thanks to the Fit Plus initiatives, which is mainly that we're able to lower down further our clinker factor and also increase our thermal substitution rate. And also we still continue reduce our fixed cost further, as well as we improve our top line through our commercial initiatives, looking at the white space that we can able to catch up in terms of the volume and price. In summary, overall, the cement and concrete business, we still very much rely on the infrastructure projects and commercial as well as industrial segment, whereas our light building material overall on track in terms of performance, except the conduit business. This is due to the weak demand in the residential segment. So that's overall performance for Thailand.
Let's talk of South Vietnam. On the left-hand side, you can see the cement demand in Vietnam. It fell drastically from 22 to 23, nearly about 35%. And as we observe, the demand starts to pick up, both on the retail and the infrastructure side. And we foresee 7 to 8% growth, mostly coming from Q2 or let's say in H2. All the positive signs, the government has taken multiple steps by easing the fiscal and monetary policies and spends on the infrastructure in the country. With this demand coming back, we have had a higher top line in terms of volumes and price. However, Q1, like I mentioned earlier, the demand is lower due to the tech festival, which went for almost 2 weeks, and the demand after that took a little longer to come back. However, the operating EBITDA margins continue to be strong, coming from lower variable and fixed costs. Sri Lanka, same story. We see a 10% demand increase. As you can see, the reduction from 22 to 23, very drastic due to the continued socio-economic issues facing the country. So we see a 10% increase in the demand, and we could see it already in Q1, where the demand actually grew much more than that. As you might recall, Sri Lanka had in Q4 much more than expected rainfalls. So we had lower volumes, lower construction activity and lower volume sold. But that would have meant the farmers, the rural economy had a better crop and more disposable income in the rural side. And so we saw a better development of volumes and also prices in Q1. The lower energy costs and the tailwinds from the restructuring activities last year, very lean structure in Sri Lanka, also meant higher margins in Q1. Bangladesh has had a satisfactory Q1 despite all the challenges of demand and supply faced in that market. Recently, the Bangladesh government announced pegging of the Bangladesh taka to 117, where the last 3-4 months average has been about 110 Bangladesh taka. This would mean massive increase in the input costs, as clinker, gypsum, fly ash are all imported materials in that country. So we will have a more challenging Q2 and rest of the year. However, Q1 was satisfactory. Cambodia. As you can see on the left-hand side, the demand has come down from 9.8 to 8.2 million tons, while the capacity is going up. The demand is going to remain stable or stagnant for 2024, as both infrastructure and retail demand will remain flat. The Cambodian economy is quite dependent on FDIs, and China was investing a lot of money from 2019 to 2022. And we see that not happening or happening at a much lower pace in 2024 and going forward. The margins remain quite intact, again coming from the internal initiatives, but also lower energy costs for the Cambodian operations.
Next will be ESG part. Kumon will give us the overall detail of the ESG for group CO2 emission first.
Thank you, Kap. So I'm very proud to inform everyone that our group CO2 emission reduction that we done quite a significant performance. You will see now in the first quarter of this year, this is the first quarter where we have the CO2 emission reduction below 600 kilogram per tons of cementitious. So according to the first quarter, we achieved 572 kg per tons of cementitious, and this is 5% reduced from the average figure last year. So the main reason, because of the first one, this is more on the product mix, where we can get the good contribution from other countries like Vietnam and Sri Lanka. They have the bigger portion for the retail segment. So that's why that's contribute to lower the clinker factor. In Thailand as well, that we done quite a good number and a good achievement in terms of the lower clinker reduction. Later on, I will brief you in the details. And the second one, this is thank you to the sales team that we able to convert our product from OPC or ordinary Portland cement, move to Portland composite cement, or here in Thailand we call hydraulic cement. So this also is helped to reduce our clinker factor. And last but not least, on the thermal substitution rate, this one also the big improvement. So the next slide will show you our achievement in terms of the TSR. you will see now in the first quarter, we achieved already 27.3%. This is a big improvement compared to our baseline in 2020. I'm talking about almost 150%. That's a big improvement. And even to compare with last year, 2023, we achieved at 21.2, and this is improvement 30% according to Q1 this year. And the key reason because of we still continue to use our RDF and replace our thermal substitution rate, replace all the clinker the coal. So that's why we achieved that target. And we implement as well the new technology of the chloride bypass, so that also helped to improve the TSR further. And biomass, that's another point that we try to use biomass, but it's not in a significant way. But at least biomass also contribute to that TSR improvement. The next one on the clinker factor. Clinker factor also you will see now the good improvement compared to the baseline 2020. This is 5% improvement, and we achieved in the first quarter this year at 71.6%. And the main reason this is because of our product conversion that I already highlighted. And also thanks to our good investment on the separate limestone grinding project. So that also helped us to improve and reduce the clinker factor further. It allowed us to implement the new product, which is lower clinker factor and low carbon product. But we still maintain our good quality and very consistency of our product. So that's the key highlight for the first quarter this year. Thank you.
Thank you.
Thank you. Next, can you please share with us for our way forward for 2024?
Okay. So let's talk country by country. So Thailand is major contributor to our top line and bottom line. And we have, like Prolantri said, we have had a slow start in Q1. And now that the government budget has been approved and they have, let's say, relatively shorter window to spend and bring money to various projects, we see a very positive outlook for construction in the remaining months of the year. We still have the risk of energy prices if they were to go higher than the current levels. We do hope, we foresee they will remain range bound, but that's something beyond anyone's control. And if they were to go north, it would have an adverse impact on our cost. The price competition because there's huge capacity overhang in this market. So the price competition will continue to remain in the Thai market, as everyone would like to be for higher market shares. Vietnam is showing positive signs of recovery, again driven by infrastructure-led investments by the government. The overall real estate market will take a little longer to recover, but we are seeing positive shoots of recovery in not only in infrastructure but also the retail demand along the Mekong Delta region. Long-term outlook is positive, and we stay very positive on that country. And we are continuously evaluating to expand our clinker production capacity in that market. Sri Lanka, as I mentioned earlier, there is a positive momentum in the country with lower exchange rates, low interest rates, low inflation rates. FDI start to come in. The downside or the risk is there are elections in this year in Sri Lanka in Q3, and if the new government was not to continue with the initiatives agreed with IMF, this may have a downside. But largely, we remain quite positive of what we see in Sri Lanka as of now. Bangladesh, while Q1 was very good, as I mentioned, the subsequent quarters will see increased input costs coming from the depreciated Bangladesh taka. We are yet to see how the demand and supply and the cost and the price increases in the cement sector, how they sort of balance or counter each other in the subsequent quarters. We are going to watch it very carefully and take necessary actions. Compared to competition, we have a head start on our overall cost base, which we started as a part of Fit Plus early this year in Bangladesh. The Cambodian market, the demand will remain stagnant, as I mentioned earlier. So our strategy there is to maintain a market share in the retail segment where we are very strong, and also bid for the infrastructure projects initiated by the government in the country. Overall, based upon what we saw in Q1 and what we see now, the 1.5 months in Q2, we remain optimistic, though cautious, as the uncertainties at the global geopolitical issues still exist. Thank you very much.
Thank you very much. This is the end of our presentation. Next will be Q&A session. Now I will take the submission assistant. First is that ask about the capacity utilization. What is how much capacity utilization rate in each country?
So in Thailand, as we had informed earlier, we have 5 kilns in Saraburi on the cement side, and we plan to run a 3-kiln operation. We had shut down 1 kiln in COVID in 2020, and the second kiln was shut down last year. So we run 3 kilns at 100% capacity. About 70% of the capacity is used for the local demand, so it's enough for the local demand, and the rest of the capacity we earmark for profitable exports and also sales to neighboring countries of Cambodia, Myanmar, and Laos. And these countries are showing lower and lower demand, as in the case of exports over time. In case of Sri Lanka, the clinker capacity is 100% utilized because we are the only ones who produce clinker, and rather than importing clinker, even though clinker prices are all-time low, we still use those kilns at 100% capacity. As the cement demand has come down, so we have 3 grinding operations in Sri Lanka. Currently, we are using only 2 out of the 3, and we can easily start the 3rd grinding mill as soon as the demand comes back. Vietnam, the same, like in Sri Lanka, we use our kiln to its optimum capacity so that we don't have to buy clinker. Just to mention that in Vietnam, we don't have enough clinkerization capacity to meet the cement demand in the market. So last year, as the demand fell by 35%, meant one of our grinding operations had to be mothballed, which can be restarted when the demand comes back. So on the clinker side, 100% utilization. On the grinding side, one of the 4 grinding operations was mothballed last year. Others are being used at its optimum capacity. Bangladesh, we have only 1 grinding operation, so we need to run it at 100% to get the most cement out of it. So we have no choice but to use it at 100% optimum capacity utilization.
The next question: within next 5 years, the company has explored any opportunities for its investment in overseas?
Yeah, excellent question. And this is something which we continuously work upon. Cannot share the exact details as we are still proposing to our shareholders and board. But broadly, we are looking at, in the next, let's say, medium to long term, we have 4 avenues of growth. One, cement itself. But cement in the existing markets we operate, they already have an overhang of the capacity. So we will look at geographical expansion, if at all, as far as cement is concerned. For us, what makes more sense is to go downstream. And here, we are already present in aggregates and light building materials. And these are 2 areas where we want to closely look at expansion in terms of the capacity, in terms of new products through innovation and renovation. We don't want to focus on commoditized products, but work with specialists using technology, construction technology, and come up with products which are far more useful from an energy or heat perspective, and come up with those better options for the consumers to pick construction materials in the downstream market. Last but not least, we have a substantial investments in the waste management side. And that's one area which is the circular economy. There is a lot one can do both for sustainability objectives, but also commercially. So that's the 3rd area where we continuously look for what we can do more, and we can do some interesting investments in that space.
Next question: please elaborate on your FIT initiative and how you will continue to enhance this.
Yes, thank you so much. Another question very close to our heart. FIT Plus program is basically getting more from what we have, from our assets, from our customers, from our people. That's the premise. So it is a very simple approach of optimizing through innovation and renovation. So the way this project works is across 3 lines: top line, variable cost, and fixed cost. Now, when it comes to top line, there is a lot we can do on the customer side, working with the customer. Manthi mentioned about the product mixes for sustainability, but also generating higher overall margin. So there are a number of initiatives around increasing or improving our top line, and this is across all product segments and services. Variable cost. Some part of variable cost is not controllable, like the energy costs, But on the usage of energy, there's a huge opportunity to optimize all the time. So meaning, whatever price you pay for the energy, first of all, you can also optimize, you can buy better. And we have had a new coal strategy for 2024, which is so far working extremely well for us. But having said that, whatever price a plant receives its inputs, they can use less. They can use it more effectively. That's what we call the usage variance, or a positive inputs used per ton of clinker or per ton of cement. There's a huge potential there. On fixed cost, it's like what we are saying is we must have structures and spends which are fit for reality of today. And the reality of today in most of the markets is the demand is not going to go up, what it used to be. It's going to be either stagnant or come down. Now, if the demand side is not going up, you need to reorient your structures for that demand. And if you look at the P&L of the cement industry at large, it has changed significantly from, let's say, 5 years ago. If you look at the average energy prices, be it diesel, crude oil, coal, they are all much higher from the last 5-10 year averages. And we don't see it coming down for different dynamics in those industries, which means that if we have to generate a certain margin to refinance our capex and generate a margin to give a handsome dividend to our shareholders, we need to readjust our fixed cost to be able to deliver a certain margin, EBITDA margin, which is then financing all the other requirements that we have. So that's how, at a design level, we are approaching the FIT Plus program. And in addition to these 3 lines, what we are also saying is identifying people at middle and lower management levels who own the initiatives. So when Manthi and me review these initiatives, they are not presented by vice presidents or senior managers. They're presented by people who are actually doing that activity, so that they own the initiatives and they are accountable for it, and they have KPIs around that. So this is a bit of a high-level explanation of how we are approaching FIT Plus program.
Maybe we have to stop for maybe last question.
Okay.
If you have more questions, then you can contact our IR department. So last question is that given the positive Q1 result, are you considering an interim dividend payment this year?
Yes, that's always our intention to give back to our shareholders, and you're absolutely right. We have had a positive Q1, and we do hope that Q2, with all the initiatives that we are doing, we will have a positive development of Q2. And if that would be the case, we would definitely consider and propose to our board of directors to consider an interim dividend for 2024. Positive about it. And this also means that if we are able to do it, then we go back to where we were 3-4 years ago in having an interim dividend consideration every year. So very positive about it as of now.
Maybe one last question.
Yeah.
What is the cost of biomass compared to coal cost?
Yeah.
Last one.
So here, we have to first explain biomass is one of the ingredients or one of the items in our TSR of 25 to 30% of our target for next year. We are at 27% now. Biomass is something that we don't want to use at 100% levels, but it is still coming at a cost which is 60% of the coal price. So we still prefer to use it in our overall mix of, let's say, energy sources other than coal. What's more important for us is to bring the waste, the high value to us in terms of what we get a disposal fee, but and those waste items also bring high calorific value. That gives us the most mileage, even much higher than the biomass. But to answer your question, biomass is probably, it used to be 20-30% of the coal price, but as the coal prices went up very high, the biomass prices, demand and supply has also gone up in the last 12 to 18 months period.
Thank you very much. I think we cover most of the question, and if you have more further question, you can contact our IR department. And today, thank you very much for our senior executive, and thank you very much everyone for joining our call and meeting. And wish to see you again next time for Set Opportunities Day. ขอบคุณค่ะ
ขอบคุณครับ สวัสดีครับ